Hi, I'm Chip Stites, and this is The Laughing Retirement. Now, today we're going to talk about a market update. We're going to take a look at where the markets are and what they're doing. And so we're going to touch on a number of topics today. Not just the markets, but also how you feel about your money. And along that lines, if you have any topics that you'd like me to cover, please put them in the comments below and we'll do a video on it. It's not a problem. If you have something you don't understand, if you have concerns, if something you're doing doesn't seem to make any sense to you, if something bothers you, if you'd like to know more about something, send me a comment. If I can do a video, I will do it, first off. Second off, if I can't do a video on that particular subject, and the biggest reason would be that I don't feel I know enough about it. If I can't do a video, I'll put it in comments right back again. I'll tell you what I can and can't do. It's not a problem. So let's talk about the market. Let's take a look at where we are today. Now, we tend to look for gold in everything. We tend to want to buy a stock that just, boom, takes off and I'm a millionaire. Everybody tells you about it when they do it. But if everybody was doing it, then we'd all be millionaires, wouldn't we? And I wouldn't be doing this. So there is a reason why people say, oh, I've hit 10 stocks in a row and I did this and I did that. They didn't tell you about the 50 or 60 or 70 or 80, 90 stocks that didn't go up 100%, that didn't even go up 2%, that went down. And all I talk about with people is that I want you to pay attention to your money. And I want you to know that everything that glitters is not gold. But just because it's not glittering doesn't mean it isn't gold. We're going to take a look at some things today that ought to tell you something about how we manage money and why we're successful at it. So let's keep going. Okay, number one. So far year to date, the ups and downs continue. We've been down a lot more, and right now we're down not too much. The Dow is down, excuse me, 0.06%, not much, almost even, but it's down 6% from its all-time high. That's not a lot. The NASDAQ is off 1% for the year, down 4% from its all-time high. That's not a lot. The S&P 500 is up 1.52%. 3% down from its all-time high. The Russell 2000, and here's the one that I kind of look at, that I pay attention to. The Russell 2000 is off 5.97%, and that's 14% from its all-time high at the moment. Now, I've told you before, but I pay attention to the Russell because the Russell 2000 is the smallest 2,000 stocks on the exchange. These are small businesses. Why do I pay attention to small businesses? I pay attention to small business because they're the ones that are trying to grow. They're the ones that are borrowing the money. They're the ones that are most economically sensitive. So you can see that in terms of small business, we still have a problem. Now, the perpetual income engine, my portfolio year to date, is up 4.3%. Now, this all goes along with Warren Buffett's famous saying, rule number one is don't lose money. We're going to talk about that more as we go on. So let's take a look at why the markets are so volatile and why I think this is going to continue. Maybe even at a very, very flat continual rate for a long, long time. We'll talk about that. Number one, the U.S. debt at its current rate is unmanageable. We have to do something about it. If Congress doesn't do something about our debt, you are going to have a severe problem with your money because the rest of the world would like nothing more than to have the US dollar no longer be the currency of international trade, because that's the only thing that allows us to print money. And if anybody else can become the currency of international trade, they will be able to print money. And if you don't think that a government doesn't want to be able to print money, well, you've got another thing coming. So there are a lot of people like Christine Lagarde that would like, head of the World Bank, that would like very much for the dollar to fail, to use another currency or group of currencies as the currency for international trade, or the reserve currency, if you will. So cutting our debt is very, very, very important. It's a much discussed and never accomplished problem. I can remember all the way back to Eisenhower, Reagan, Nixon. Oh, we want to control our debt. We want to control our debt. We want to control our debt. The last person that had any money to control the debt at all, the last administration which balanced the budget, was Clinton's administration. He had a surplus. He had a choice between paying down the debt or giving money back to Congress and his cronies so that they could pass it out. Guess which one he did? I hope it's not too hard to guess. Now, even Ronald Reagan said, I want a small government. I believe in small government. And yet during Ronald Reagan, the government grew 10 times. We have a current lack of stability that you can see in the United States. You can see it on our universities. You can see it with the problem in Gaza, Ukraine, Iran. You can see it with our willingness to hurt others in our own country to justify our own beliefs. You want to know why markets are volatile? Right now, because everything is volatile. And that's not particularly good for markets. Now, so what drives the future? Well, among other things, interest rates, the Federal Reserve, and our debt. Now, you've been hearing that the Fed is on a normalization kick. They want to normalize rates. And all that's great. All they're trying to do is get rates back up to where they were. Now, where were they? Well, they're right about where we are right now. I think I heard the other day the 30-year mortgage is at 6.38, something like that on average. Well, over a long period of time, the historic average of a mortgage is 7 to 8%. So we're close. You will also notice that with this increase in interest rates, you're having a slowdown in new mortgages, a slowdown in buying houses. You're also having, with higher interest rates, less housing being built. So there's a housing shortage. Why? Because it costs more to build a house right now. And I've read somewhere that the average mortgage right now is over $30,000, and people are having to borrow the money to put the money into the house in order to get the mortgage. Now, it used to be you couldn't do that. Well, our business is business. And so they've relaxed the rules on that, evidently, so that you can borrow money from mom and dad, or getting a gift from mom and dad in order to have your down payment for the house. Now, higher and lower interest rates are a balancing act. So the Fed has got a real problem here, because if they tighten too much, the economy slows and you've got a recession. If they tighten too little, the economy goes faster and faster and faster, and now you have more spending, and now you have more debt. They're walking a tightrope. That's why I'm hoping for a soft landing, which is they're able to normalize rates and not get a recession. Excuse me, at the same time. Now, higher rates curb spending, but remember, when rates go up, so does the cost of our debt. Relatively simple. When rates go down, the cost of our debt goes down. But then when the cost of debt goes down, the tendency is to make more debt. So it's a problem. And the best example is kind of housing and mortgages. Housing generally represents, give or take, 15 to 70% of our gross domestic product. Well, when you slow down 15 or so, 17%, 18% of the economy by raising rates, you begin to worry about that R word in recession, because you've hit or slowed part of the economy that the economy depends on. New houses means new construction, means new appliances, means new furniture, means new mortgages. There's a lot there, isn't there? And so we want to make sure as we go forward, the Fed is trying very hard to have that soft landing. And believe me, when the president dislikes the Fed chairman, Jerome Powell, it's not unusual. He's not going to be the first president that didn't like the Fed, because the Fed is supposed to be independent, and I hope it stays that way. It's supposed to be. You don't want politicians managing your money, believe me. If this last 6 or so months hasn't proved that to you, you've got a different kind of a problem. Now, what else matters? We see overspending in the government is not just a government problem. It's a consumer problem as well. Because right now, consumer debt is at an all-time high. It's at $18.2 trillion, and that's 3.9 trillion more than it was before COVID. And that was an all-time high. So you see, consumers are having to slow down because they don't have the money either. Now, that's why people begin to talk about recession. Are we headed for one? Well, there are a bunch of signals out there, and let's look at the first signal. I call it the soup signal. The soup signal, people stop buying Campbell soup. Why? Because they can buy Kroger soup, or they can buy Safeway soup. They can buy a store brand that is cheaper than a national brand. So Campbell's is suffering because consumers are cutting back. They generally look for the cheaper things so that they can stretch their dollar a little bit farther. So what's a recession? Well, a recession is 2 quarters of negative GDP. And because of the way they report it, because it takes time to put all those numbers together, and because they often revise them a quarter after the quarter in which they reported, we don't know if we've been in a recession till we're out of one. So very often, it doesn't hurt us much. We don't think about it much. Now, the global recession worries are rising for obvious reasons. I mean, we're not the only country with a debt problem. God only knows most of Western Europe has the same problems that we do, and often to a greater extent than we have it. So what are the economic triggers? Well, some of them is that one of them is a contraction in gross domestic product. We produce less because things are slowing down. Rising unemployment. Right now, we don't see that. Unemployment's 4.2%, and the unemployment numbers came in very good just a bit ago. Lower stock prices. Well, can't say that. The numbers are kind of mixed right at the moment. Decreasing industrial production. The amount of production that people are bringing into the country is an effort to stem that problem. Trade tariffs and economic uncertainty. Yes, that's a big problem right now. An inverted yield curve. That's where the short term, 1, 2, 3 years on bonds costs more money than the long term. It should be like this, with interest rates going up as the term gets longer. Well, right now, it's like this, with interest rates higher at the short end, lower at the long end. Supposedly, that is something that tells us that we're going for a recession because people are worried about the future. They don't know what price to put on the future. They aren't comfortable with what's going to happen in the future. The only problem with that, well, there's an old joke that the inverted yield curve has told us about 9 of the last 2 recessions. basically meaning that an inverted yield curve doesn't always tell us that we're going to have a recession. Lower wages and greater layoffs. Yes, we are having some layoffs. Decreasing consumer confidence. Well, consumer confidence rose for the first time in May. There are a lot of signals out there saying yes. There are a lot of signals out there saying no. Obviously, we're not just boom and go right now. Do I think we necessarily have to have a recession? No. I believe a soft landing is possible. Now, what do I worry about? Excuse me. It's got a little allergies right now. I don't worry about a recession, and I don't try to jigger my portfolio around all the time because of a recession. Because what I've done is look at what the masters say about all this stuff and followed their advice. And it really is quite simple. Whether or not there's a recession, I'm going to make money. And if you're not doing things the same way we are, which is basically low risk, low cost dividend investing, so that your dividends go up every year, so that you put more money in your pocket every year, so that you keep up with inflation every year. If you're not doing that, yes, a recession bothers you because you're worried about the price coming down. I don't care about the price coming down of the stock. Why? Because my stocks have already put money aside to pay me their dividends. But I guarantee you, Tesla doesn't have a lot of money set aside for its stock drop, if there is one. Neither does Google. Neither do any of the AIs. If the price of their stock drops, the price of their stock drops. That's it. You get to live with it. Congratulations. If the price of my companies drop, most of the time they already have their money set aside for dividends for the year. I don't have anything to worry about. Matter of fact, when the price goes down and my dividends stay the same, I'm going to get more shares in my reinvestment. So when prices go back up again, I'm going to make more money than most people because it's consistently. The markets will be affected by an economic drop of recession, but companies paying dividends plan for the dividends ahead of time and often have the money set aside for the next 9, 12 months so that they can pay their dividends. Because a dividend investing, a company that pays dividends is more in line with what I need, is more in line with my growth than they are with your growth. Not only that, but when a company does cut its dividends, if its stock is down 30%, we're in the third or fourth or fifth quarter of a recession, yeah, you will get some dividend cuts. That'll happen. But most of the time, the dividend cut that you will get will be a 10% cut. So let's say the price of a stock falls 30%. It was $100, now it's $70. And let's say that stock was paying me 5%. And they cut their dividends after a year in a recession. They cut their dividends 10%. 10% of 5% is 0.5%. In other words, now I'm making 4.5% instead of 5. Well, if you're counting on price, you lost 30%. I'm counting on dividends, I lost 5. And they still paid me 4.5%. Which would you rather have? I'm telling you all the time, what you want is consistency. That's why this market update is to point out that we are in an inconsistent time, and this is not likely to stop. Now, what can you do? First thing you can do is lower your risk. How do you do that if you've got mutual funds? Well, I don't have any mutual funds, frankly. I don't want any of them because I know that 90% of the time, they're going to underperform the market. And I'm going to show you what my numbers are. I want you to look at them carefully. And what I'd like you to do is to pay attention to your numbers. Pay attention to the real numbers that you are making. So if I have $1,000 and I put in 100, I put in 10%. If at the end of the year I have $1,080 and the market went up 5%, I lost money. So you need to know how much you put in, you need to know what your company matches, and you need to know what your funds did. Dollar-wise, not percentages. You need to know, I put in $100, I had this much, this is much I got. What's the result? Now, look for companies that pay you for the risk you assume when you buy their stock. Otherwise, you're just giving your people your money for free. And I've never understood that. I don't understand it. Companies that pay dividends tend to drop less. They tend to go down less in market drops than companies without a dividend. Why is that? Because people hold on to them. People hold on to a stock that's paying them money. Whereas if I've got 150 shares of Tesla or 150 shares of whatever, NVIDIA or an AI stock or whatever, and they go down by 30%, that's what I got. I got a 30% loss if I want to sell. Otherwise, I got to hope it goes back up again. So you want to look for the kinds of companies that pay you for the risk you take, number one. You want to lower your risk, number two. You want to make sure that your beta is low. My beta is 0.63. Now, you should be able to go to your financial advisor and say, hey, what's my beta overall? The weighted beta in my portfolio. If they tell you, I don't know, you're in the wrong place. And if they come back saying standard deviation, say, no, I want beta. Standard deviation is a little bit harder to understand. Beta is a little simpler. Beta is the movement of your stock or the movement of your mutual fund against, or as it moves against the average movement of the S&P 500. So that if your movement goes like this and the S&P 500 goes like this, well, then you know that your stock or your mutual fund is moving twice as much as the S&P 500. That would be a beta of 2. My beta is 0.63. I don't want my portfolio running around all over the place. Now, one little book that I think you should read is John Bogle's little book of common sense investing. Now, he says that you can do a 401k portfolio with 4 or 5 index funds. That's it. He's right. You don't want those index funds to cost you more than 0.1%. You want it at 0.03, 0.05, whatever. You want those mutual funds to be paying you some kind of dividend. You want those ETFs to be paying you some kind of dividend. And you don't need 15 or 20 ETFs because you'll have a ton of overlap. Because one ETF won't talk to another one and say, listen, I have 100 shares of so-and-so, and they talk to another ETF and they say, well, I've got 300 shares of the same thing. You aren't going to know about it, and all it did was increase your risk. Because if everybody goes after the same thing, i.e. the Magnificent Seven, those are the stocks that are going to collapse the farthest. Now, William Graham, the father of value investing, used 30 stocks to test his theories. Now, he could have used 50 or 100 or 200. He used 30. Why? Because if you diversify those 30 in different sectors, there are 11 sectors of the S&P 500, you can put roughly 3 stocks in every sector, or 2 stocks in some sectors and 3 in others, and you can have pretty good coverage with 30 stocks. I have about 35, 37 stocks. It's easy to understand. It's easy to manage. I do it twice a year. I look at everything. Now, John Bogle, the founder of Vanguard Funds, who died in 2019, he was quite a man. He didn't like what he was seeing. And he basically suggested, get the book, he basically suggested that if you have the S&P, the Russell 2000, a bond fund, and an overseas fund, a large company fund, a small company fund, bonds, and an overseas fund, you got enough. Very, very simple. If you're looking at 10 or 15 different investments, believe me, you have no clue and your FA has no clue what you've got. They don't know how much your overlap is. And I will bet you if you said, what is the total I am paying every year for those mutual funds, they won't know. They'll say, well, I'll get back to you. You want to know, what am I paying for my investments and what am I getting for what I pay for now? What you should do now, I'm going to read you a little something. Now, I can't predict what the market's going to do. I look for long-term, whoops, we went somewhere here. We did go somewhere. There we go. I think the boom and bust cycles are shortening. I think they're going faster and faster and faster and faster and faster. Now, that means that things are going to go up and crash and up and crash and up and crash. And I don't think most people who are retired want that. You want to sleep at night? It's not a very good idea. I don't care what the markets do. I'm going to sleep well because I know what I'm getting. Now, in times of uncertainty, recessions are more likely. We have had 25 years of artificially low rates. Free money is a hard habit to break. Higher interest rates means lower home sales, higher mortgages. Excuse me. Wow. Evidently, that allergy pill didn't do too good. Mortgages, and lower rates mean lower credit card numbers. Now, as the rates go up, the credit card rates are also going up from 13 to over 20%. That's significant. That increases the payment that you have to make on that credit card or that mortgage significantly. And that's why home sales and retail sales are slowing down. We have a debt problem, decades in the making. We aren't going to get over it in 1 or 2 years. It's going to be some time. And that's going to cause everybody concerns. Now, I want to read you something that I would like you to pay careful attention to. This comes from John Bogle's little book of common sense investing. This is on page 196. No business can forever ignore the interest of its clients. The fund industry could do so. He's talking about mutual funds in the 80s and 90s because it was blessed with an incredibly powerful market whose returns 18% from stocks or 80% higher than the normal, and 10% from bonds, which is 100% higher than the long-term average. In other words, there was a lot of money to be made. And so people weren't paying any attention. And we had 2 decades in which we didn't need to pay attention to what we were getting. Now we need to pay attention. Now is not the 80s or the 90s. Now is not a time where things are quite as simple, where money is quite as easy to come by. You got to remember, in the 80s and 90s, what was happening to interest rates? Interest rates were coming down. That ended in 2008. Interest rates are going back up again because we have to control our debt now. While investors seemed willing to accept the loss of a few percentage points from those enormous returns, if they were even aware of the impact of those all-in costs are. And I say all-in costs all the time, and I'm not sure that people understand what I'm saying, but I want you to. What's an all-in cost? Well, if your FA says, I'm charging you 1%, and then you got a series of mutual funds, 1% is not your all-in cost. Your all-in cost is the cost of those mutual funds plus the cost of the FA, plus the underperformance of the funds against the S&P 500 or against their indexes. Now, if they were not aware of the impact of those all-in costs, they surely will not accept such loss in the environment of sharply lower returns on stocks and bonds alike that seem to be certain in the years ahead. I hope not. But I don't think most people know how much they're getting. I don't think they know how much they're paying. I had one lady say, well, I'm paying about 1%. By the time I took her private placements, by the time I took the cost of her FA, which was over 1%, she was paying over 2.5%. She was paying over $17,000 a year on her portfolio. Now, as the dollar continues to fall, international stocks will benefit. So, increasing the amount of international stocks that you have in your portfolio will help you. Dividends, you want greater than 4.5%. Now, if you're in a mutual fund or an ETF, that's got to be a high yield fund. But I'm telling you that I have a beta of less than almost that, 0.6 minus 0.63 at the moment. I'm earning over 5% in dividends. And I couldn't do that in a mutual fund. And my cost is less than 0.05% because I have two closed-end funds. What do you want to pay attention to? Well, if you want to lower your risk, one of the things you can do is pay attention to what consumers have to use every day. What's the first thing you do when you walk in your house? Turn on the lights. That's utilities. What's the next thing you do? You go to the grocery store to get food to eat. That's consumer staples. That's food, among other things. Tobacco, liquor, things that people use all the time. What's the next one? You go to the doctor, healthcare. Those three things, utilities, consumer staples, and healthcare. Those are the sectors of the S&P 500 which will drop less in a market fall most all the time. Rising rates are challenges for real estate, finance. They can also be challenges for some utilities because utilities use short-term rates. And any business that needs to borrow money. That's why the Russell 2000 is struggling a bit. So I'm suggesting that you pay careful attention to your money now, because the markets are not going to get less volatile. The markets are more likely to become more volatile and more likely over an average to be flat. That's why I use the formula. Taxes plus inflation plus the cost of investing plus 1 to 3%. That's all you have to make. Put that down on a spreadsheet. Learn that. You got to make taxes. Let's call that 20% net. Inflation, 2.4% right now. Your cost of investing, if you have an FA, it's between 1 and 3. Plus 1 to 3% that you need to make for yourself. So if you got rid of the FA and you got rid of the expenses, then you've got taxes, inflation, and 1 to 3%. And now you say, Chip, I can't manage my own money. I can't do that. I don't know how. Well, let's talk about that. It's not that difficult. I'm doing it. And I'm certainly no genius. Limiting losses is so important. Number one rule for Warren Buffett, don't lose money. And if you look in here, John Bogle said the same thing that Warren Buffett said. The enemy of the equity investor is expenses and emotions. A process can help you eliminate emotions, and expenses are easy to eliminate. But let's talk about market up and downs a bit, because you're going to see a more volatile market. Market losses of 38% and a gain of 40 is still a loss. If I have $1,000 and I lost 38%, that's 620. If I have 620 plus 40%, that's 868. If a market loses 5.5% and gains 5.5%, you've still lost money. $1,000 less 5.5% lives 945. $945 plus 5.5% is $996.67. You're still over $3 down. After 2008, it took 5+ years for the S&P 500 to get back to its old high. 2008 to 2013. After 2008, it took my portfolios and my clients roughly 18 months to get all their money back. Here's why. In 2022, the S&P lost 19.8%. My portfolio made 3.38%. In 2023, I gained 0.3% or so, and the S&P gained 24%. So who won? Who made more money? Buffett's rule number 1, don't lose money, comes into play here. Because if you did that with the S&P 500 and $1,000, you would have $996.89. But with my formula, I had $1,036.90. Now, I'm just using $1,000. I'm not using 100,000 or 1,000,000. This is where the rubber hits the road. This is where you need to take responsibility for your money. Is it frightening? Is it difficult to do? No, it's not difficult. If you can learn to ride a bike, if you can do simple math, you can do this. Now, eliminating the expenses of an FA and mutual funds and investments will quite literally would have doubled the amount of savings you would have today had you done that 10 or 15 years ago. But it will do the same in retirement. If you learn to do this in retirement, the amount of money you will have to use will double because you aren't sending it to somebody else. You see, when the market goes down 32%, the market goes down 30%. And you're sending 1% to your FA, and you're sending another 1% to your mutual funds, which are also, by the way, underperforming. Instead of losing 30%, you're losing 32 to 33. That's 10% worse. Now you have more to recover. So what can you do? Well, very simply, you can do nothing and retain what you have. You can get a lower cost FA. I can find you one. I can find you an FA that has 60% lower costs. You can learn to manage your investments for a 5% income that grows annually. You can do that. It's not difficult. I can show you how. Learn to lower your taxes. If you do things the way you're doing them, you're not going to be able to lower your taxes. If you do things the way I'm doing them, the way the perpetual income engine does them, you can lower your taxes from 24% to 12 to 15%. That would put even more money in your pocket. And what will that do? When you retire, it'll grow your savings every year. It will give you more of a corpus because you're not sending it to somebody else first. Believe me, you're sending it to them first. You don't even know if you'll make money, and they've already got theirs. You need to make sure that your expenses are under control, particularly in a volatile market. You know what's strange to me? I've never had anybody call me and say, Chip, I want to go through those expenses with you. I'd love to do that. I'd love to show you how I came up with that, because John Bogle, in his testimony before Congress, which is right there, said I conclude that the high cost of ownership of mutual fund shares over the long term is likely to confiscate as much as 65% of the more of the wealth that retirement plan investors could otherwise easily earn. He said 65. I didn't believe him. So when I first read this a number of years ago, I started my own spreadsheet. I took all my own information. His information said 65. My information said closer to 50. It costs you 50% of what you would otherwise make to use mutual funds and a financial advisor. Can you do this yourself? Yes, and I can show you how. Is it scary? No. Once you understand it, it's simple math. That's all this is. This is a process and it's math. You can lower your tax costs from 22 to 24% down to 12 to 15. Not difficult. You can increase your overall savings, your income by 50%. It's a pretty good deal. And it's not hard to do, and it's not expensive, and it doesn't take long. Now, here's what I suggest you do. Watch my financial videos and my masterclass. Learn how every foundation builds its portfolio. Just not difficult, guys. Foundations have been around for a long time, and they have to pay out money every year. That's no different than you. You need money every year to pay your bills. That's what you're going to be doing in retirement. That's what a foundation does all the time. Now, learn how to get rid of your costs. Learn how to take less risks. Learn how to get more into your pocket. It's easy to do, 4 steps. It's not difficult. Inexpensive to learn. It's less than you're paying right now. You're going to start saving money even when you're spending money learning. Because my costs of doing things are a lot less than your FA's cost of doing things. Get a 20-minute free chat right here. Here's the link. Get the chat. I'll sit down and talk to you. Or better yet, sign up for the lessons. Free for 2 weeks. If after the first 2 lessons in the 2 weeks you don't want to do this, fine, stop. Get a free mutual fund to ETF conversion sheet. Get the last retirement calculator free that you'll ever need. Because it doesn't calculate how much you'll have at retirement. It calculates how much you can spend. What you have doesn't make any difference. Yes, the more you have, it'll help. But it's what you can spend that makes the difference, not what you have. If you have a budget of $200,000 a year and you save $2 million, not a whole lot different than the person who has a budget of $20,000 a year and has saved $200,000. Much the same. And I can show you how to handle it. It's not difficult. This is my 45th year or so in the financial services industry. And the more I learn about it, the more I learn that the industry takes care of itself first and its clients second. That's why John Bogle said it that way. Sooner or later, the industry will have to learn. Well, I don't think they have. And I think you're paying for it. So I hope you will take some time. Free 20-minute chat. There's no pressure here. I don't believe in that. It's your money. It's your life. Call me. Ask me how I do it. Let's go through this a bit. Ask me how I can prove what your expenses will be if you don't do this. Let me show it to you. Send me a list of things that you would like me to talk about on these videos. I'll be happy to. I enjoy them, frankly. it's a fair amount of fun for me. Now, thank you very much. Good luck and good investing. Let us know how we can help you. I'm Chip Stites, and this is The Laughing Retirement. You guys have a good day.